welcome back to this week's market update. Today is Monday, May 11th, 2026, and we'll jump right in. Stocks continued to rally last week to new all-time highs as a better-than-expected April jobs report and a robust corporate earnings season supported investor sentiment. As of Friday, May 8th, the Nasdaq Composite led the major indexes with a 4.5% weekly gain, followed by the S&P 500, which was up 2.3%, and the Dow up a slight 0.2% last week. Moving into our economic data from the week, labor market data came in, as I mentioned, stronger than expected in the month of April, with non-farm payroll rising by 115,000 jobs, above expectations of 55,000, though below March's pace and below the longer-term averages. The unemployment rate held steady at 4.3%, reinforcing continued labor market stability despite the slower hiring environment. Job growth was led by healthcare, transportation and warehousing, retail trade, and social assistance, while federal employment and information services continued to see payroll declines. Notably, information employment is actually down now over 300,000 jobs, or about 11% from its most recent peak in November of 2022, highlighting increased efficiency and leaner staffing models across the industry. Average hourly earnings rose 3.6% from a year ago, remaining slightly above March's inflation rate, though real wage growth could continue to narrow and may turn negative depending on April's CPI print coming out this week. While the pace of hiring remains below the longer-term historical averages, payroll growth has been fairly strong in 3 of the last 4 months, as you can see, suggesting that labor market conditions may be potentially improving in the coming months. Also last week, the University of Michigan's Consumer Sentiment Index weakened in the month of May, falling more than expected and actually reaching a new all-time low, down 3.2% in the month and 7.7% in the year. Under the surface, real income expectations continued to decline, reflecting growing pressure as inflation increasingly threatens to outpace wage growth, as we also took a look at in the previous slide. Survey responses also showed a notable rise in concerns around high prices, both for general personal finances as well as major purchasing decisions, with roughly 1/3 of respondents mentioning gas prices without being prompted. The index suggests consumer sentiment remains under pressure for many households, even as equity markets continue to trade near record highs. Continuing on in our weekly economic news, we also got the ISM Manufacturing and Services Indexes for the month of April recently. The manufacturing PMI held steady month over month at 52.7%. Still a fairly bullish reading, anything above 50 being a positive indicator, anything below 50 being a bearish or negative indicator. So this being at 52.7 is a positive reading there. New orders strengthened in the month, continuing to be quite bullish there. On the other hand, production fell slightly but was still in bullish territory. And then employment fell to a further bearish stance at 46.4% in the month. However, this was paired with higher prices. This was actually the highest prices paid reading at 84.6%, the highest reading since 2022. So those are some warning signs you want to take a look at there. And we'll see a similar trend in the services indexes in the next slide. As I mentioned, the services index also remained in expansionary territory in the month of April at 53.6%. Falling slightly from March, but still in a fairly positive position. Within the index, you can see a similar trend. We had employment below 50, although it did improve slightly in the month, paired with higher prices that were stable in the month here, but still quite high at a reading of 70.7% in that component. So overall strength as a whole in both services and manufacturing, but some warning signs of weaker employment and higher prices. Last but not least, taking a quick look at where we are in the Q1 earnings season. Overall, earnings have come in much stronger than expected. You can see here the S&P 500 is expected to post 27.7% year-over-year earnings growth in Q1, which is more than double the 13% that was originally expected. This has really been the primary fundamental driver behind the market as we have a lot of lingering geopolitical risk. These incredible earnings have been the thing propelling equities to new all-time highs. By sector, leadership has come from information technology, which impressed quite a bit. Originally expected to post about 44% EPS growth, posting instead higher than 50% year-over-year earnings growth. Communication services has been a stellar performer, originally expected to see a slight earnings decline, currently posting about a 48.8% increase in earnings from a year ago. And then on the other end, we have healthcare, which was originally expected to post an EPS decline of more than 8% from a year ago, now posting a much thinner 3% decline in earnings. So overall, a lot of broad-based strength in Q1 earnings season. So that concludes this week's market update. We really appreciate you tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.